Okay. Now let's try to understand what is a variance analysis, and let's try to understand that through some real world example. So let's take the example of Starbucks cafe. Let's suppose that Starbucks store prepared an annual budget for one of its outlets. Now the annual budget looks like that. The price per coffee will be around $5. This is the average price they will be selling, and the volume they will be selling is 100,000 cups. And their variable cost per cup, like coffee beans, milk and cup, they have identified is $2. And they also have some fixed cost in terms of rent, salaries and utilities for their people, which is of $200,000. Now based on that, Starbucks plan what will be their budgeted contribution margin. So their contribution margin to the business will be their sales minus their variable cost. So the contribution margin is only the variable contribution what they are earning from their business. So we can say they will be selling 100,000 cups at $5. So they will be getting $500,000, and their variable cost will be $2 for these 100,000 cups here. So that will gives us $200,000. So effectively their budgeted contribution will be $300,000. Now what will be the budgeted operating profit? We know that along with this benefit of $300,000, there will be fixed cost of $200,000, making it the budgeted operating profit of $100,000, which means if you reduce from contribution margin the fixed cost, you will be getting your budgeted operating profit, which is your $100,000. Now what happens at the end of the year? Actual result come, because these all were budgeted, these were in their planning. So what happens actually, that actual sale value volume was 90,000 cups, actual sale price was $5.2. This may have happened because some new product might have launched whose price was higher compared to what initially was planned as $5. So actual sale price is $5.2, and actual variable cost per cup is $2.1. So an actual fixed cost overall is $210,000. This may be due to the reason that the salaries may have gone up and down, some people are not getting hired or additional people hiring, some electricity or utilities charges have gone up or down, and similar other things might happen. So these are the fixed cost. Now if someone asks you what is your actual contribution margin, so you will be saying 90,000 cups are sold at a price of $5.2 per cup. So 90,000 at a price of $5.2 gives you $468,000. And if your variable cost needs to be counted, so you will be saying at 90,000 cups variable cost will be $2.1, making it $189,000 and giving you actual contribution of $279,000. Now what will be your operating profit here? So you will be saying out of this $279,000 of contribution margin, you have a fixed cost of $210,000. So if you reduce that, you will be getting actual operating profit of $69,000. Now we need to see the variance analysis here, that why the variance has occurred. So let's try to evaluate and see that. So Starbucks sales volume variance due to lower or fewer cups sold, that has occurred because they have budgeted that 100,000 cups will be sold, but actually only 90,000 cups have been sold. So this is a negative impact, and due to this there will be lower contribution margin, and instinctively we know this as well. Let's try to see the price variance as well. They have sold at $5.20 versus 5 which they have planned. So they have sold at a higher price, which means that it will have a positive impact and it will give us higher revenue per cup. If we see the variable cost, so actual variable cost was $2.10 versus $2 which was planned. So the variable cost per cup is higher here. Instinctively we know that it will have negative impact, maybe due to higher milk or coffee cost which may have increased. And finally let's see about fixed cost. So actual was $210,000 versus $200,000. It instinctively we know that it's a negative impact, and higher rent, utilities or other things might have happened. So the net result will be like what we have budgeted was $100,000 as the operating profit. However, in effect, we are earning $69,000. So the overall variance or adverse variance or unfavorable variance for us is $31,000 here in terms of profit. So in summary, what we are trying to say that Starbucks planned to earn $100,000 but they earned only $69,000 because lower sales volume and higher cost outweighs the benefit of slightly increasing price. This illustrates how variable cost analysis helps management to identify where things went off plan and take corrective actions. So based on that, the corrective actions can be taken. Now let's see the textbook concept for this variance analysis as well. What does this say? So the definition is like when we compare actual results with budgeted results or standard results, we call it as variance analysis. The purpose is to do planning and setting financial goals and controlling if the performance goals are met. The first step is to like compare actual performance with the annual business plan what we have seen, and within that there are two kinds of cost categories. One is variable cost, second is fixed cost. The variable cost are cost which changes with production and sales volume. If you keep on changing the production or sales quantity, this cost keep on changing. Your fixed cost remains constant regardless of production and sales. So if your production increases or decreases, it doesn't matter, your salaries and utilities will more or less remain same. Now budgets are based on set at sales price per unit, set variable cost per unit, set fixed cost in total which we have discussed, and we got the contribution margin which was our sales minus variable cost, and from that contribution margin if we reduce the fixed cost we get our net profit. So this way we try to understand the basic textbook concept of variance analysis. In the next sessions we will be looking at some examples in more detail.